During the first half of the year, few groups performed better than the high-yielding real estate investment trust. Investors flocked to dividend stocks because the returns to the bond market are so meager. One of the biggest winners, Kimco Realty, one we've liked for a long time, up more than 20% year-to-date after hitting a brand-new post-financial crisis high last Friday. Given the weakness in much of retail, you might think that Kimco, which is North America's largest publicly traded owner and operator of what's known as open-air shopping centers, would be having a difficult time. You'd be wrong. Company reported a robust quarter last Wednesday, meeting Wall Street's estimates with a terrific 96% occupancy rate, while the same property net operating income, the REIT equivalent of same-store sales, increased by 3.1% year-over-year. Plus, Kimco announced a series of initiatives to help clean up its balance sheet, control costs, put it all together in this real estate investment trust with a 3.2% yield looking pretty darn good, even after the recent run. As long as the Fed holds off on raising interest rates, I think people are going to continue to be in this bond market alternative position, and they're going to like Kimco. So let's take a closer look with Connor Flynn. He's the president and CEO of Kimco Realty. Hear more about how his company's doing and where it's headed. Mr. Flynn, welcome to Mad Money. Thank you, Connor. Have a seat.
Thanks for having me.
Okay, like so many people, I talk to a lot of funds, hedge funds, and they say, oh, geez, Kimco Realty. I mean, that's exactly in the crosshairs of Amazon. But the truth is, when I look at the companies who are in your shopping centers, almost every one of them can easily compete against Amazon.
It's exactly right. We like to say we're in the sweet spot of retail. It's the off-price concept right now is thriving. And there's a lot of, talk about the omni-channel approach to retail as well. And that's where you're seeing people being very good at both e-commerce as well as physical bricks and mortar. And the ultimate, Amazon recently announced opening physical stores.
All right. Now, you've got some really high-end really, I'd say the highest-end supermarkets. Are they concerned about Amazon and same-day delivery?
I think what's happening right now is people are trying to test a lot of different products. So the same-day delivery, they're trying to put basket size together for people. You'll probably see more of them try out drive-thrus as well, so people don't actually have to come into the grocery store and deal with maybe coordinating your kids. So there's all sorts of things in trial and error period right now, Instacart and others that are launching and partnering with different grocery banners. But right now, obviously the grocery business is a very thin margin business. Yes. And so when delivery comes in the equation, it makes it very difficult to make the numbers work.
Okay, you have excelled in having some unbelievable off-price discounters that we've recommended on the show endlessly. Ross and TJ being the best examples.
Absolutely. TJX and Ross are two of the shining stars in retail today. They've done a phenomenal job of really pinpointing what the American consumer is looking for. And that's really a value play as well as a convenient play. So what we like to say is we take advantage of the last mile. So our ownership position in the real estate that we own is very close to where people live and work. So that's that last mile. That's that connectivity point.
And that's what Don Wood from Federal Realty was telling us. He says it's not so much that they love to be on Amazon. They love the convenience of Amazon. They therefore love the convenience of Kimco because your shopping centers are some of the best real estate all over the country. When I look at the distribution, I think about the Sports Authority situation because you have them. And it's a short-term headwind, but a long-term tailwind. Is that a correct way to view it?
I think that's the right way to look at it. We're at a 38-year low in new supply, so virtually no new development. So it's a good place to be when you're a landlord because you really have the leverage right now. And we just hit an 8-year high in occupancy. So that means we can really drive rents. Just for example, this past quarter, the new leases we signed were almost 30% higher than the previous rent that was being paid. So you can see the supply and demand that we have going in our favor right now.
There's a mention at the end of the conference call about Kmart. You have a long-standing relationship with Kmart, but some of these leases have been 20 years. I mean, in some ways, you kind of want Kmart to kind of move on.
Yeah,
I know that there are tenants, so you're not going to, but you know what I mean in terms of those. How about this? Those leases are worth more to someone else.
No question about it. We like to think of them as future opportunities.
Okay.
So they are very low rent paying.
Right.
They're usually, the ones that they have are in great pieces of real estate that you'd love to redevelop. Right. Maybe even add density, so going vertical. Some of those leases were signed in the 50s.
Jeez.
And we're the last standing single level building where towers have gone up around us. So it's just ripe for redevelopment.
Now, I wanted to know, there's an outfit that we happen to like, but not the stock. The stock's been uncomfortable, but it's Bed Bath. And you have, for instance, there's a great Kimco shopping center right near me. There's a King's, and right next to it is a Harmon, and it's really terrific. And it's in Short Hills. And I'm thinking, okay, Harmon's doing great, and across the street's Bed Bath, and their balance sheet's good. But, when you saw Sports Authority, their numbers started going down. Bed Bath's numbers going down. Does it hit your radar screen, or you look at the balance sheet?
We look at both. I mean, we definitely look at both. And Bed Bath has been a great retailer for a long period of time. And they have a lot of different flags. So they do have multiple different concepts. Like you mentioned, Harmon. Beauty right now is doing fantastic. So look at Ulta. I mean, unbelievable.
Now, a lot of people, the short sellers say, oh, Jim, Ulta, they're everywhere already. But that's not true, right? I mean, they have a model where you need many more Ultas.
Absolutely. And they're actually looking at taking pieces of the Sports Authority boxes that we have. Absolutely. So they're a great player for us to take more space and just continue to grow. It's the health, wellness, and beauty concepts. They're doing fantastic.
And how about
right now.
pets?
Absolutely. Petco,
Talk about that,
PetSmart.
because we happen to think that the humanization of pets is one of the great secular themes.
I was fascinated to see in the last downturn, nobody cut back on pet spending. It was
Is
the
that
one
not
thing,
unbelievable?
I mean, you cut back on what you're feeding yourself, but you keep feeding your dog, organic dog food. It's unbelievable.
We are convinced that is, we try to look at themes that lasted through the oil decline and through the recession, and we just come back to pets. And you can't, Amazon Pets that I know of.
They're part of the family is really what it comes down to, right? Is you just look at them as part of the family, and you want to give what's best to your families.
Well, Kimco's been a great story. We've been backing you ever since we heard people say that it's a short, because we know your stuff, and you know your stuff. That's Connor Flynn, the president and CEO of Kimco Realty Corp, a great stock with a great yield. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.